As we head into the weekend, the U.S. markets are now closed, and Plug Power finished the week with a notable session. At the closing bell on Friday, October 17, 2025, the stock stood at $3.40 per share, down 2.30% for the day, or about 8 cents. It was an active session, with the stock trading in a range between a low of $3.37 and a high of $3.59, ultimately closing near its lows on significant volume of over 105 million shares. Now, seeing a 2.3% drop on a stock this volatile might not seem like much, but the immediate detail that most traders might have missed happened on the very same day. Just as the stock was sliding, analysts at TD Cowen came out and reiterated their buy rating, but more importantly, substantially raised their price target from $3 all the way up to $4.50. This creates an immediate and fascinating tension. Why is a respected firm becoming more bullish on a day when the price action itself is weak? This isn't just a simple pullback, this is a snapshot of a battleground where the narrative and the numbers are in a full-blown conflict. The general expectation for Plug Power, the story that has captivated so many investors making their first online investment, is that this is the poster child for the green hydrogen economy. The belief is that Plug, with its end-to-end ecosystem, is poised to be the Tesla stock of its sector. It's the name that flashes across the Robinhood stock trading app, promising explosive growth as the world shifts to clean energy. This expectation has fueled incredible rallies and drawn in a massive base of retail holders who see a path to a green future powered by this one company. They see the forklifts in Amazon and Walmart warehouses, they hear about the government support, and they see a stock that once traded at massive highs. The expectation is that it's only a matter of time before it returns to glory. But the reality, the data sitting on the screen of a professional trader using the Interactive Brokers trading platform or a wealth manager at Fidelity Wealth Management, tells a far more complicated and precarious story. The reality is that Plug Power is a company hemorrhaging cash. While the bulls and analysts like H.C. Wainwright, who set a stunning $7 price target earlier in the month, see the future, the bears see a company with a history of negative gross margins and staggering net losses. The reality is that the consensus analyst target, when you average all of them, is hovering somewhere between $175 and $230, which implies that even at this 340 close, the stock could be significantly overvalued. So that 450 target from TD Cowen isn't just a bullish call, it's a defiant one, flying in the face of a much more sober and frankly bearish consensus. This is the core tension, the dream of a hydrogen future versus the nightmare of the current income statement. Let's look at the recent movement, because it has been anything but boring. This stock is not for someone just looking for investment help in a stable, intelligent portfolio. This is the definition of a high volatility trading vehicle. The entire month of October has been a microcosm of Plug's entire history. It started on October 3rd with an explosion. The stock rocketed up over 34% in a single day on nearly 500 million shares of volume. This was triggered by that H.C. Wainwright note, the one that set the $7 target, citing rising electricity prices making green hydrogen more competitive. That momentum carried over, gapping the stock up again on October 6th. But since hitting a 52-week high of 458 during that spike, the sellers have taken firm control. We saw a 6.3% drop on October 7th, the same day the company announced a major leadership change, with Andy Marsh stepping aside and Jose Luis Crespo being named the new CEO. Then, on October 8th, the company announced it had raised approximately $370 million through a warrant inducement transaction, This is a classic Plug Power move. Use a stock price surge to raise desperately needed capital, which in turn dilutes existing shareholders. Following that news, the stock has been in a steady downtrend. It fell 4.9% on Wednesday, got crushed by 9.6% on Thursday, and followed up with Friday's 2.3% loss to close out the week. The volume has been immense, regularly clearing 150 million shares, indicating that this isn't a quiet drift lower. This is active, heavy distribution. So who is doing all this trading? Looking at the ownership structure is revealing. Unlike a blue chip like Apple stock or a behemoth like Nvidia stock, which are dominated by institutions, Plug Power is a retail favorite. Recent data shows that retail investors, the self-investing crowd, may own as much as 56% of the company. This explains the wild swings, the passionate defense of the company, and the extreme sensitivity to news. Institutions, like the ones that create Fidelity ETFs or Fidelity mutual funds, own a smaller portion, around 38%. The largest holders are the giants you'd expect, Vanguard and BlackRock, but their positions are largely passive, reflecting the stock's inclusion in various indices. More telling is the recent institutional flow data, which shows that in the last quarter, more institutions decreased their positions than increased them, and the average portfolio allocation to Plug among funds that hold it has actually decreased. This signals that while retail investors on SoFi Invest and the Robinhood app are buying the dip, the smart money has been, on average, a net seller, using this retail-driven liquidity to lighten their load. To understand the bull versus bear fight, you have to understand what Plug Power actually does. Because the company it is today is different from the company it was, and both are different from the company it promises to be. For years, Plug was primarily a material handling business. It built and sold hydrogen fuel cells for forklifts, a niche it dominates. Its key customers are massive logistics operations like Walmart and Amazon. This is its bread and butter business, but it has historically been a low margin or even negative margin business. The investment thesis, the big story, is the pivot to becoming a fully integrated green hydrogen supplier. This means they aren't just selling the fuel cells, the razor, they are now manufacturing the electrolyzers that create the hydrogen, the razor factory, and building their own hydrogen production plants to sell the hydrogen, the razor blades. This is the multi-trillion-dollar opportunity. They have brought new production plants online in Georgia, Tennessee, and Louisiana, with a stated capacity of 40 tons per day. The major news on October 1st was a huge proof of concept for this new model. Plug announced it had delivered its first 10-megawatt electrolyzer array to the Galp refinery in Portugal for a massive 100-megawatt project. This is the bull case in a nutshell. They are proving they can build and deliver the hardware for the new energy economy. This brings us to the future outlook, the expectation versus reality for 2026 and beyond. The bullish scenario, the one underpinning that $7 price target, is built on this electrolyzer business scaling rapidly. The bulls, who are likely using platforms like Fidelity or Interactive Brokers to build long-term positions, point to the Galp deal as the first of many. They also point to a new, powerful narrative, the energy demands of artificial intelligence. The argument is that data centers are becoming so power-hungry that the traditional grid can't keep up, and they will need dedicated, clean power sources, which Plug Solutions could provide. The company's management, now under a new CEO, has guided for achieving positive gross margins by the end of 2025 and positive EBITDA by the end of 2026. If, and this is the biggest if in the market, they can hit those targets, the stock is unbelievably cheap at $3.40. The bearish reality, however, is brutal. The primary risk is existential, cash burn. This company has lost nearly $2 billion in the last 12 months. Its financial statements are a sea of red. To fund these losses and build out its new plants, it has to constantly raise capital, primarily by selling stock or using warrant deals like the one on October 8th. This is a classic Plug Power move. Use a stock price surge to raise desperately needed capital, which in turn dilutes existing shareholders. Following that news, the stock has been in a steady downtrend. It fell 4.9% on Wednesday, got crushed by 9.6% on Thursday, and followed up with Friday's 2.3% loss to close out the week. The volume has been immense, regularly clearing 150 million shares, indicating that this isn't a quiet drift lower. This is active, heavy distribution. So who is doing all this trading? Looking at the ownership structure is revealing. Unlike a blue chip like Apple stock or a behemoth like Nvidia stock, which are dominated by institutions, Plug Power is a retail favorite. Recent data shows that retail investors, the self-investing crowd, may own as much